A broadcast just saying like people can come in if there are any. So. All right, it's exactly 3 o'clock. Are you ready to go, Brad? A broadcast just saying that people can come in if there are any. There. Okay, so are you ready to go?
Yeah, whenever you are.
All
We're
right.
good.
Sounds good. Okay. Welcome everybody to our 40th episode of our Bay Area Housing Market Town Hall webinar. I know last week I had to cancel last minute. I'm so sorry. The weather somehow is back to last week's weather as well today. Well, last week after the power outage, cell outage, and this crazy hurricane style wind, I just felt ill. I could not work. I could not do anything. My head just hurt so badly. So, and funny thing is today is back to the same weather again. So all day I just kept thinking, oh my God, am I going to have power outage? Am I going to do the webinar or do I have to cancel again? So hopefully it's all good because I know my kids' school, they had a power outage earlier. So let's get started. I want to remind everybody to go to our YouTube channel and subscribe so that you can get notification right away as soon as we post these new videos out. And let's get to it because I think there's so many things that we want to talk about, especially after last week's episode and on the market. So, but let's start with some statistics with the Bay Area housing market updates. All right, let's look at some number here in terms of number of actives, what has been going on. Did the inventory comes back? And if you look at this right now, we see that the number of active listings on the market is still kind of low compared to last few years. And if we look at our January 2023 listings, and then if we kind of go across, you'll see that the numbers are still quite a bit lower than last year's and also the previous 3 years. So we still don't have a lot of listings, and then we still hear a lot of our buyers complain about that there's really nothing to look at, unfortunately. But we do see a lot more buyers coming out though. Now, but let's look at the number of sales compared to the number of active listings. And we've been reporting to you guys how the market has slowed down quite a bit since last year, April. And this gap where the yellow line is the number of active listings versus the number of sales, as you see that starting last year, April, the gap has become so much wider, right? The number of active listings compared to number of sales, because the interest rate has gone up so quickly, a lot of buyers just pull back and say like, you know what, we're going to hold, we're going to wait. And on top of that, as reflected here is that the sellers also didn't want to sell. Sellers or the homeowners who have very low interest rate, they decided that they're just going to hold off and wait, maybe rent it out, or maybe they just decide not to move. And then the other side is that the buyers just think that I'm going to wait until the interest rate can come down or the price can come down. So definitely you see this huge gap starting April 2022, but then you do see the gap is starting to kind of go back to a little bit narrower, but is still much wider than what it was before April 2022. Now, in terms of the months of inventory, we are a lot better than January. January, we have 2.5 months of inventory down to 2 months of inventory. And again, we mentioned to you that, you know, a normal market is 4 to 6 months inventory, right? So we are still pretty good. And I have to say though, in the last couple of weeks, we've seen some crazy number of days on the market, and then how many people are making offers on some of these properties. So I'm expecting that next month, we're probably going to see this month of inventory drop down a little bit more. All right, so in terms of median days to sell, and like I mentioned earlier, you see this huge drop because we start seeing a lot more activities. It went from in January 2023 was 28 days on the market, dropped down to 14 days on the market only. So it's been, we see listings that are well prepared definitely move a lot faster nowadays. And then in terms of like the competitiveness, we went from below asking went above asking price. Although it looks like it's only 2% over, but it's actually pretty significant if you're combining 5 different counties and then look at the numbers and see how right now, the competition, basically, we do have to offer over asking price. All right, so what happens to the withdrawn and canceled? We've been watching and tracking for the past few months because we saw like this huge jump from January 2022, 45 in Santa Clara County, jumped all the way up to like 400 listings in Santa Clara in June of 2022. But since then, you're starting to see that number of withdrawn and canceled has slowed down quite a bit, and it came back down to 124 listings in February 2023 for Santa Clara County. And San Mateo County, it went down from 132 on the peak. Oh, sorry, actually 167 at the peak in August, went down to 60 listings only that was withdrawn. And then Alameda County, it went as far up as 500 listings and then now down to 154. And San Francisco, it went as far up almost 300 listings. Oh, actually, in December, there was a lot of listings withdrawn in December because the market definitely has slowed down. At the time, a lot of people were planning on waiting until next year, basically this year, to buy. So that's why in December for San Francisco County, we had 362 listings and down to only 82 listings. And in Contra Costa County, of course, you see that there were as much as 450 in August 2022 and down to 157 listings only. And now, in terms of this chart, we're gonna see that we are looking. Oops, sorry. Let me say. We're looking at the list price decrease for different counties, and again, we had quite a bit of the pricing decrease to Santa Clara County at 688 listings in August that had a price decrease and down to only 171. And the San Mateo County down to 83 listings, Alameda County down to 194, but it went to as high as like 800, almost 800 listings back in summer of 2022. San Francisco County and had gone down from 457 to 134, and Contra Costa County, it went from like 837 in September and down to 224. So all of these counties, you pretty much see that the number of listings have price decrease. They all came down besides San Francisco. San Francisco actually had come up slightly since December. We start seeing a little bit more of listings have price decrease. I think they were expecting a little bit better demand over there, but it's not as high as they thought. So they still continue to have decrease listing price decrease in those markets. And in terms of transaction fell through, there are about 87 listings combined in 5 counties. Only 87 in 5 counties. So we're talking about thousands of them, and there are only 87. But you'll see that because there's still these concern among the sellers, we do see sellers still choosing cash offers over finance offers. They are still kind of like feel uneasy because the lending institution have so many restrictions nowadays. The interest rate is still fluctuating. So we do see that a lot of sellers are still choosing cash offers over the finance offers. Now, in terms of like the pricing, the median sales price for each county, you see the Santa Clara County, last month we did tell you that it came up slightly from 1.465 in December, went up to 1.5. It came back down to 1.475. But San Mateo County, this is one number that I had to double check. I was like, whoa, what's going on? It went down a little bit to January for 1.48, but all of a sudden it came back up to 1.95 median sales price in San Mateo County. This is obviously, it's just like one off. There's this one particularly high price in San Mateo County, but it's just interesting to see like how the price has gone up quite a bit over, out of like hundreds of listings, and there was one that actually jumped up. And then Alameda County, the price had gone from 1.02 to 1.07. And for San Francisco County, it went from 1.385 to 1.44 in February 2023. And Contra Costa County went from 725,000 to 750,000 in February 2023. So across the board, besides Santa Clara County, most of them, they actually have gone up in price compared to last month. But if you compare to last year, the price definitely did come down about, I would say average about 22% from Santa Clara County, 18.06% drop from last year. San Mateo County actually, if we use this 1.95, is the same, but I highly doubt that next month we're going to have the same price, despite we do see a much higher demand. Well, let's see if next month we're going to see $1.95 million still. And the Alameda County dropped about 19% from last year, and San Francisco County dropped about 25% from last year, and Contra Costa County dropped about 17% from last year. But we're almost there from last year's peak. Last year's peak, as you see highlighted here, they are around April and May of 2022. So it depends on which counties. But you see that in Santa Clara County, we basically dropped about 24% since last peak. And then San Mateo County is 13% since last peak. And Alameda County dropped about 28% since last peak. And San Francisco County about close 30% since last peak, and Contra Costa County about 23.47% since last peak. And I think this is also another reason why right now, around this time as we speak, we do see a lot more people coming out because they have noticed that the price have dropped so much compared to last year. So and at the same time, they feel like this is the interest rate has kind of slowed down and going up so fast, so they have come out to start looking at properties as well. All right, so this is the chart that I want to show you guys with the offer battleground, where we've been making offers. We're looking at how many people are competing for one property. As you see, we have some mired one in Los Gatos, Los Gatos one for single family homes, and asking about 3.675. They had 3 offers. It's still multiple offers, still gone above the asking price. And then in San Jose, this is like West San Jose. As you see, a single family house asking 2.3. They got 16 offers and went about above $2.5 million. And in Alum Rock is San Jose area for fixer, $919,000, still received 5 offers in less than a week, and they received several cash offer, and in the end they accepted it in 3 days only. Here and some other southwest San Jose area, you see that they are competing with 30 offers. From 1.288 went up to 1.558, or 1.1 asking price went up to over $1.3 million. Is staggering to look at how many offers are there right now. And then when we are helping our clients make the offer, of course, sometimes they just shocked. They didn't think that there are going to be so many people. And just out of all these people, all the offers came in. I'm sure every single buyer was like, wow, the market did kind of like jump back up pretty quickly. And here Santa Clara, same thing. You'll see a lot of double digits or 9 offers, and then the sales price also significantly higher. And even this is a very interesting one, we thought, because the seller, actually, I thought, we haven't seen this and we should see a little bit more. The seller is trying to sell this property with seller financing, and he has a 4.25% interest rate that he's willing to sell or finance to a new buyer for 10 years. And who wouldn't want a 4.25% right now? Because you can't get it anywhere. Even though it's a fixer, well, I would say it's very dated and needs updating. They received 16 offers and they sold it at $1.35 million. And here you go, Milpitas, single family, 1.1 asking, received 44 offers and sold between 1.35 to 1.4. So it's the same story. And I'm going to tell you, Palo Alto, Atherton, double-digit offers, so well above asking price. While San Francisco, here is a condo, $960,000, they received 1 offer just right around asking. So it's kind of interesting. San Francisco market definitely not as crazy as the South Bay at this time. All right, so let's look at the mortgage rates as well. Now the mortgage rates, Freddie Mac, I don't know what's going on. They stopped giving us forecast. The last report I could find was October, and then I haven't seen any updates from there forecast anymore, but still continue to have forecasts from Fannie Mae. We got an updated one from February 2023, and the Mortgage Bankers Association March 2023, and National Association of Realtors March 2023. And again, reminding everyone, if you're not used to my chart, I have indicated in the parentheses here, basically the negative 30 basis point is the differences between the last update, which was January 2023 here, versus their new forecast. So their new forecast actually dropped. They expect that we're going to end 1Q 2023 at about 6.1 for the 30 years fixed conforming loan limit, and then 2Q for Fannie Mae 2Q, the forecast is going to be at 6%. They dropped from their previous forecast at 6.4%, and then 3Q at 5.9 and 4Q at 5.7% for the 30 years. As for Mortgage Bankers Association, they expected to end 1Q 2023 at 6.4, which is higher than what they had forecasted back in December 2022. And then 2023 2Q, they expect to be at 6.1%. 3Q 2023 at 5.7 and 4Q 2023 at 5.3. Now, National Association of Realtors, their forecast had changed quite a bit, has gone up 60 basis points compared to last forecast, and it has gone to 6.7% for 1Q 2023, 6.3% for 2Q 2023, 5.9% for 3Q 2023, and 5.6% for 4Q 2023. So again, that we are seeing, good news is that we start seeing all these projections going under 6%. So I'll be very curious to see, because I think a lot of people, when it went above 6%, a lot of buyers are definitely really hesitant, especially for conforming when it hit almost close to 7% at one point, but now it's coming back down and coming back below 6%. I think that's going to attract a lot of buyers coming back to the market. All right, so in terms of like Wells Fargo, they have given us some, every month they give us like updated interest rate, and the 30 years fixed hasn't changed since last month. So it still stays at 5.5% for jumbo loan rate. So you see that jumbo loan is much lower than the conforming loan that we just told you guys about. Is over 6%, but jumbo loan for 30 years fixed is at 5.5% currently. And what about the rental market? Now, if we look at Yardi Matrix, the National Multifamily Report, and we're looking at comparing all these different other cities, other markets, I was quite surprised, because San Jose at 6.1% rent growth is actually doing better than Los Angeles, San Francisco. Oops, excuse me. Click. Ooh. All right, here it goes. 6.1% for San Jose is doing better than Los Angeles, 4.5%, San Francisco, 3.2%, Inland Empire, 3.2%, Orange County at 3%, and Sacramento at 2.3%. And that continue that they are still thinking that the rent growth forecast, this is from Yardi Matrix. And by the way, Yardi is a software that a lot of landlords, they utilize to track the rents. So that's how they get all the data from nationally from a lot of different markets. And they are forecasting rent growth for year 2023 for San Jose at 3.3%, which is higher than the other metro market in California. And then the job growth is at 4.8%. And so I thought this is a pretty interesting number, because San Jose seems to be outpacing the other markets in California based on this chart. And then in terms of rent to income ratio, I think this is even more interesting for me to see, because I kept reading, I just want to make sure I read it right. It says rent to income ratio, and Sacramento is actually at 42.9%, much higher than San Jose at 28.2%. Maybe I almost want to say, like, Brad, did I read it wrong? I mean, it's saying that the rent is 42.9% for Sacramento of their income. So, I mean, it can make sense, right? Because San Jose, the median income is so much higher compared to the other market. But it's really, I guess I'm pleasantly surprised and pleasantly happy to see that we're at 28.2%, which is lower than even in Sacramento and especially Inland Empire. In terms of Los Angeles, it's at 33.4%, and San Francisco is at 29.1%. Now, what about foreclosure? A lot of people kept asking, like, I started getting a lot of people asking me, it's like, hey, do you see more foreclosures? And it's funny that this topic keeps coming back, and then people kept telling me that they really think they're gonna start finding more foreclosures. I would say that in the residential market, we're probably not gonna see as much, although commercial real estate market, that's a different story. That probably we can talk about it at a next webinar. But for residential market, I really don't think that we're going to see a lot of foreclosures. Here is a California in terms of ranking. We are still at the bottom. We are only 1.8% delinquency, 0.1% foreclosure, and 1.9% non-current. And the year-over-year change in the non-current actually is at negative 10.1%. And oh, sorry, that was actually last month's report. And then this month, we'll see that delinquency percentage is at 2%, and foreclosure percentage is at 0.2%, non-current at 2.2%, and the year-over-year change in non-current percentage is negative 15.9%. So as you see that when we are comparing this year and last year December 22 report, if you compare the number, we're actually doing slightly better because we have less non-current percentage for in California. And what about the loan counts and average days delinquency? In terms of nationally, we see that we have 52 million active count of loans, and then there are 30 days delinquency, which is around 900 loans that are delinquent, and then there's 60 days delinquency. There are about 287,000 of them, and 90 plus days there are about 580,000 of them loans that are delinquent. And in terms of like foreclosure start, there are about 32,000, and foreclosure sales completed is 6,958, which means as you see that it compared to all the other numbers is actually quite low. But I know we hear on the news that they would tell us like, oh my God, the foreclosure has gone up like by a pretty big percentages. I think that's what because they were comparing from 2020 to 2021. We had these moratorium that not foreclosing and on a lot of loans at the time. So when it kind of kicked back up, you see that the jump from 2,900 loans to 4,781 loans to 6,000. That percentage seems really high. But if you're really looking at the numbers compared to what it was back in even 2004, we're still way, way, way below what the numbers were in 2004. And of course, there's nothing, it's not even close to the numbers in 2008 to maybe 2012 and 13. So just kind of want to show you that how we really don't think that we're going to have a huge surge of foreclosure in the residential market. Now, another very popular question that I've been getting asked is this a good idea to buy a duplex, basically live in one unit and then rent the other unit out? I do think is a good idea. It depends on your financial situation, obviously. But then there are some pros and cons that I would like to go over real quickly. Pros is that, of course, you get rental income, you have a small mortgage payment, but the cons is that rental income is not guaranteed. So it could that, if your renter move out, you have a month or two without rental income. It is pretty easy to manage since you live next door, but it also means that it can be pretty difficult to be managing the tenant because you live next door. It's a tenant that you're going to see pretty much almost every day. It's right next door from you. So finding a good tenant is very important. And of course, it's easier to repair items because you're just next door. But then if your tenant constantly asking you to repair stuff, then it will be constant repairs that you have to go over. And then typically when you get two units, like duplex, it's just a little bit more than a single family, but the pool of options is a lot less to choose. And now this is the one big reason that I really think is a great idea is that the tax advantages, because if you are living in one and renting the other, by the time you sell, if there's any capital gain, you based on the percentage that you're living in, you still qualify for your homeowner capital gain exemption. And then the other part, the other percentage of whatever size that you're renting out, you can do a 1031 exchange. So I think it's still a great tax advantage to own a duplex. And but then you do need to understand all these rental restrictions in your city. Even though you're living in there, you still have to follow the landlord tenant law. So if you do have any questions, we do have previous videos that talk a lot about that as well. So I think this kind of concluded my housing market update today, but I assume that we're going to be addressing the elephant in the room. Brad, do you know what I'm talking about?
Yeah, I think it's been on the headlines for the past week or so.
Yes, that's right. I think everyone is really interested to understand what happened to Silicon Valley Bank. It is truly a really, really shocking news, right, to a lot of people. And how did it happen? And I've been reading a lot of different articles and watching a lot of different videos, and I was trying to find a way to kind of summarize the timeline. And I found this from a website that I thought, oh, I can use this. I thought this is a pretty good way to kind of explain to people how it all happened. So let's start off with like 2021 during the funding boom, because of all these like federal incentives and all that. During COVID, there was like huge deposits that went into Silicon Valley Bank, and it was $189 billion in 2021 and peaked at $198 billion. And then, so what happens if they have so much deposit, right? So Silicon Valley Bank decided that they're gonna invest heavily in the bonds, and they were issued in a very low interest rate environment at the time. And so the Silicon Valley Bank, their balance sheet for 2022 and show actually $91.3 billion of securities with mostly bonds. And then in 2022, US Federal Reserve started to raise interest rate, which what happens to the bond? You drive down the value of the bond, right? Because the bond, they were in a very low interest rate. So unfortunately, because they mostly held it in bonds, I would think that at first they thought, well, bonds is very safe, but at the same time, because the interest rate went up so quickly, it actually drove their value down. And what happened is that these venture capital firms cutting fewer and small checks to startup, and then they also have a funding, they call it funding winter, meaning that they have a lot less deposits into the bank. And because the funding depleted, the deposit made by startup institutions such as Silicon Valley Bank also started declining. Then they forced the bank to sell the securities, that the bonds that they bought, at a loss just to cover up the deposits. And that's what happened on Wednesday. Silicon Valley Bank announced that it has sold, actually it was 2 weeks ago, it had sold $21 billion worth of bond asset at a loss of $1.8 billion. And what happened once this news came out? They said that they need to raise $2.25 billion via a share sell. So that created this panic, right? Because like all of a sudden everybody was talking about it, and even Peter Thiel telling his investors to start withdrawing deposits. And but then at the same time, Silicon Valley Bank was trying to urge the customers to not spread panic and withdraw money from the bank. This is all happened because of social media. Social media was hashtag bank runs, Twitters and Reddits, a lot of these private groups, Slack, and they all started to fuel with all these topics about like, you better withdraw all the money. And so instead of they talk about like how quickly it happened. Instead of heading to a branch, they don't even walk over to the branch. They quickly pulled up a web page and logged in. It just take a few tries, eventually moved every cent to an account at a different bank within half an hour. That was how fast it was for people to withdraw money. And now let's compare what happened with Silicon Valley Bank compared to the largest bank collapse back in, was it 2012? I think it was 2012. I'm sorry, probably 2009. And for Washington Mutual, I used to bank with Washington Mutual. Now, Silicon Valley Bank, they had an asset of $209 billion. Washington Mutual was $307 billion in assets. The bank run for Silicon Valley Bank took 1 day. The bank run for Washington Mutual took 9 days. Within 1 day, they took $42 billion withdrawal. Washington Mutual, 90, $16 billion over 9 days. And that for Silicon Valley Bank, that $42 billion equivalent to 25% of their deposits. And Washington Mutual, that was about 9% of their deposits. That was how quickly social media was able to fuel this bank run that happened within 1 day, and then withdrew $42 billion worth of deposits. And also, they only have over 30 or 35,000 depositors at Silicon Valley Bank, because most of them are venture capital startups, and so they have millions and millions of dollars in there. So it is really astounding to see the numbers, how quickly within 1 day they had a $42 billion withdrawal, and eventually the next day the government seized the bank. So that's how fast it came down. So Silicon Valley Bank came down, Signature Bank collapsed, and Credit Suisse now was bought out. I think it was just yesterday. And then the next one that people are panicking about is First Republic. And just letting everybody know, I bank with First Republic. So I was obviously very, very nervous and also worried about it. They send out email right away and talk about, how stable they are. They have capitals in the bank, and they are very well diversified. So, hey, as a customer, you will still get really worried. And I also wonder if I should panic and just pull everything outright. First Republic, the stock went down 90%. But then it actually came back up today about 30. I think it went up as much as 60%. And a couple days ago, all these banks actually got together and deposited $30 billion into First Republic Bank, just to show the public that they are they want to make sure that First Republic is not going to fail. So because of that, we received another email from the CEO and the president and the founder regarding this effort, and comforting their depositors not to panic and not to pull a lot of money out. So my question is for you, maybe Brad, I don't know, should I pull my money out or not?
Depends on how much we're talking about. I'm just kidding. It's I think we were chatting about this a little bit earlier. How many more banks are going to fall? And I'm taking it. My speculative play on this is just, since everyone on TV is saying there's going to be a ton of other small banks crashing, and they all seem to be in unison, I'm going to go on the other side of the spectrum and say I don't think we're going to see a wave of a ton of regional banks collapsing, simply based on how everyone on TV is in unison. It's not foolproof, but I think it's worked out well over the past, I think, 5 to 10 years on market calls. And there's Jim Cramer's a perfect example. I think there's an ETF that bets against his market calls, and I think as right after the turn of the year, he was saying buy on SVB. So it's I guess his analysts didn't review their financials either. So it's a tough decision to make.
It is indeed. I don't want to be one of those people who panic, but at the same time, I am panicking, and so I'm curious. I'm curious about other people, what they think. If you have any comments from me too, I would love to hear what you think. All right. Oh, I'm so sorry.
You can't go wrong to share the wealth and spread it across a few. I would say, versus having all your eggs in one basket.
Exactly. Absolutely. You're absolutely right. And that's a very good reminder for people, is that sometimes you do have to spread it across, because this is a very good reminder, is that it's $250,000 insured per depositor per bank. So maybe you can clarify too. So that means if I have a savings account, and I have checking account, and I have another CD account, at all under my name, it's really all combined $250,000. It's not per account that you're insured.
I believe so, but who knows these days? I think Janet Yellen's gone all in, saying that they're backing all deposits. So a similar stance that the Fed and government took during COVID's peak, basically going all in. They were buying junk bonds, they were buying mortgages, they were buying everything to keep the market up. So it's really how much bandwidth do they have, and that's another big kind of unknown. But just trying to give confidence back in the market, I think, is what they're doing altogether.
Absolutely, absolutely. So I do hope that everybody is gonna stay safe. I hope that you guys. I mean, I have friends who have deposits at Silicon Valley Bank. I have friends who work there. I was so worried about them, and but I'm just glad that, in a sense, is it right or wrong? That's a different story. Whether the government should bail these banks out, I'm not going to get into it. But I'm just glad that at least they are doing okay. My friends are doing okay. All right, so now let's talk about how do we compete with cash buyers? Because as I mentioned earlier just now, and in some of my slides, the offer battleground, you see like sellers are accepting cash buyers still. They prefer accepting cash offers over finance offers. We still see some sellers very worried about financed offers, even though I do think that a lot of banks are stabilizing. They're not as worried anymore. Our clients are doing pretty well with their financed offers, but still, and from the seller's point of view, they seem to still prefer cash offers. Now, I know a lot of people who cannot offer cash offers. There are some other alternative, slightly more expensive, but it can work just as efficiently and as quickly as cash. So this is where Brad comes in and explain to us.
I'm going to try and, after doing 3 years of Zoom meetings and presentations, I still have difficulties. So let me try and share my screen here.
All right.
Can you guys see it all right?
Yes.
All right. So again, my name is Brad Ladislaw with SNL Capital Group. We're an asset-based lending company based out of Southern California. My business partner is located in Brea. I'm in Oceanside, and what we specialize in are writing investment purpose loans to real estate investors acquiring 1 to 4 unit properties, multifamily, and industrial warehouse throughout the state of California. Helen, your presentation earlier on the market update, I thought was very interesting how that one seller was offering seller financing on a beat up probably investment property. And that's actually a strategy we could touch on later on what some of our clients have been utilizing out there in the marketplace. That is a creative financing structure you can do, pair it up with a private money bridge loan on the front end to where you as the investor are coming in with effectively zero cash to close, and all you need to do is self-finance the rehab. So that's we're seeing seller financing being more acceptable out there, depending on how much equity is in the property. So we'll jump right into it. And at any point in time you have a question, please just send the question to Helen. She'll just stop my rambling and we could just dive into the weeds on any particular point of this presentation, but I'll try and move it along smoothly to leave time for questions at the end. So hard money, private money, asset-based loans, bridge loans. What's the difference? I feel all these terms get loosely thrown out there in the marketplace. Me personally, I don't think there's much of a difference. It just really depends on what room you're in. You talk to a real estate agent or broker that specializes in the 1 to 4 space and you tell them that you're an asset-based lender or a private lender, the first reply I get is, oh, so you do hard money. You go to a commercial networking event, we're talking to commercial brokers, multifamily, industrial, call it $2 million and above loan amounts, and you tell them that you're an asset-based bridge lender, and then they say, oh, you're hard money. I guess that's a mean way to say it. It's a mean term, but yeah, we do hard money. And they say, oh, I've never had to use hard money. I was like, well, do you have a bridge lender that could close in 14 days? And they say, yeah, I got one of those. I was like, that's hard money. I mean, you're not closing in 14 days unless you're using some sort of private capital on that. And you could drill down the meaning or definition of what term investors or lenders like to use, dependent on the capital source as well. So Helen, I'll send it to you. I wrote an article back in March of 2020 on what happened in the hard money lending industry. over the last 2 years that led up to the great pause that everyone I'm sure saw in the private lending industry during COVID. And that was mainly driven by the flood of institutional or Wall Street money that hit the marketplace. They don't like to brand them. In the beginning, they told themselves we're hard money lenders, but then they realized that their capital providers didn't like that term, so they were rebranded as alternative lenders, asset-based lenders, bridge lenders. Again, all one and the same. But if you're talking to an institutional lender, they would probably not define themselves as a hard money lender. If you are getting a private loan from Uncle Joe or Aunt Jane, actually, let me backpedal. Full disclosure, this is not investment advice to any of you. I am not recommending how you should structure real estate deals. I'm going to share what types of structures we have seen out there in the marketplace. So I just want to throw that out there.
And if I may add, is that I had used one of these hard money, or you can call private money or asset-based lending, to purchase property just like cash. It's not my cash, it's somebody else's cash, but I could close in 14 days or less as well, as long as the numbers work. And then even there are a lot of companies out there now saying like, oh, we can finance you first so that you can buy something else, and then when you sell your property, you can pay them back. That's kind of part of this private money that a lot of other banks that are using or providing. It's just that we call it differently, different names.
Yeah, and we'll jump into why someone would use private money, if it's only for investment properties, or are there consumer bridge private money options out there? Answer is yes to that. But in short, I'd always recommend that if you're going to be using some sort of private money, I'd recommend you go through a licensed company to do so. You may pay a little bit more, let's say for origination fees, but after looking at your presentation, Helen, looking at Wells or some of these other banks charging 1% origination or discount points, we got to increase our pricing. I mean, you're going 1 point for a bank loan. We're right there with them. But anyways, you have traditional trust deed models or fund models, which are backed by accredited investors. And then you have other institutional models that were backed by Wall Street money. A lot of them have hit pause, stopped lending, or changed pricing drastically over the 6 to 9 months. Not to get into the weeds too much, but they would fund loans on a credit facility, package them up, and then sell them to an end buyer. That end buyer on the secondary market, we're buying these in the forms of bonds, and they stopped buying. So that created a lot of turmoil. So your traditional asset-based lending companies have been busier than ever the last 12 months. Now, why would someone use private money loans? We tend to joke around, no one needs a private money loan until they need a private money loan. The main reason is time. Helen had alluded to this. How do you write those strong offers to close quickly? You'd be surprised how many all cash offers eventually do get switched to financing once they're in escrow and title. It's really just an addendum that switches it from all cash to financing. That's where the experience of your lender that you're working with comes into play, and they need to know how to communicate that change to escrow. My favorite line is, surprise, Helen, you get to work with me again. I'm actually going to be the lender on this one, and they just want to see that you have control over the process. But using a private money loan is really the best way to replicate that all cash offer. You could close with no appraisal options. I mean, we market sub 14 days. We've closed in as little as 3 business days before. We do not market that. I hated that. It was a very horrible situation on our end to, part the seas to make that happen, but we did. And you can't do that with any other type of financing out there. Closing on distressed assets can be very difficult with that regional bank, or if they're still lending now, or your, let's say, conventional lender. And Helen, were you going to chime in and say something?
Yeah, I just want to clarify from a realtor point of view. When we write the offer for you, we cannot, if you're doing a private money loan, we cannot write down all cash offer. Although back in, 10 years ago, back in 28 to 2013, we would write down, hey, this is an all cash offer, because it works just like a cash offers, right? It's like really quick funding, and there's no underwriting on your personal income, and it's asset based. But so regulations in the DRE is saying that no, if this is a Hartman lender, you still have to consider this a finance deal. But you can just write in as, at least it's like still very strong, very quick closing, and this is like you don't need to underwrite your own income, so it's asset based. So before you make an offer, a lot of times Hartman lender can already tell you whether they will loan you the money or not.
And that's a great point. We like to review a deal very early in the process, especially with our high volume borrowers. They'll shoot my business partner, Corey, an email with the property address, estimated scope of work, estimated closing timeline, and their estimated ARV. And he'll jump in the weeds, do preliminary value check, and say, here's ballpark of where we'll be. Like, let's rock and roll, because we like to pre-approve our borrowers in that fashion. We've been seeing offers written now, all cash, or they'll write in hard money. And to realtors, all fairness to agents and realtors out there, you may not even know that your client's going to use hard money. So you'll see an all cash offer written, and then you're just as surprised as escrow and title. And it's I see how that could put you in a tough spot. But again, that comes into what lender are you working with? Do they have the experience? We've been fortunate to do enough volume in our target markets that chances are we've worked with that escrow officer or that title rep before. So it's a very smooth conversation. With our pre-approvals that we send out to our clients as well, with our clients as well, to write those offers, we make sure our contact information is on those pre-approval letters, so that listing agent can call us and talk to us and say, have you worked with Helen before? What's going on with this deal? Is this loan really there? And we could update them and share how they could vet us as a lender, our processes, and kind of calm the situation a little bit and help. At the end of the day, we just want to help our borrowers close more deals, which helps agents and brokers we work with close more deals as well. Stereotypes out there, I won't go through them or dive into the weeds on them, but hard money stereotypes. We want to take the property. We charge high points, high interest. We're not flexible, and it couldn't be farther from the truth. Very competitive on our pricing. If our borrowers succeed, we succeed. We don't want to do one deal with them. We want to do 20. So it's more so an understanding the situation that's going on, and let's just try and wash, rinse, and repeat is what we like to do. So here's some questions that we recommend our clients ask your lenders. We'd be very naive to think that our borrowers only work with us. I mean, I think I got a great smile and I'm nice to talk to, but that only goes so far. So we recommended our clients talk to as many lenders out there that you can, and ask process-based questions. Personally, I think asking about pricing on your opening question is completely irrelevant, because if they can't meet your 14-day closing timeline, pricing doesn't matter. So some questions that you could ask to make sure that they're going to meet that closing timeline. Are you a direct lender or are you a broker? Brokers bring great value to transactions, but they're not making that credit decision. We rely on brokers to send us deals to fund on their client's behalf, but they may not be aware of what that actual closing timeline is. So that's a very fair question to ask. And I think brokers bring great value to every transaction, and they could try and get the best pricing for you as a borrower. Do you balance sheet your loans? What this means is, does that investor hold those loans to maturity, or do they sell them off on the secondary market? If they sell them off on the secondary market, they're reliant on that end buyer to always be there. So COVID, a lot of these end buyers hit pause. So a lot of deals at the funding table fell through. We saw this pause and shakeup happen again last year, and then it happened throughout the course of the year as interest rates were running up. So that's a very fair question to ask. And balance sheet lenders, again, hold their loans to maturity, so that end risk is not quite as prevalent. AMC, do you require an AMC for your appraisal, an appraisal management company? So a lot of the institutional money that flooded the marketplace, they required, same with conventional lenders, that you order that appraisal through an AMC. During 2019, 2020, 2021, 2020, they were busy. So sometimes, depending on the market, it could take up to 14 days to get your appraisal back, and you just hope that there's no revisions that need to be made. We don't require an AMC, so we could use appraisers in a target market that we've worked with before that we have vetted, so we could get those appraisals turned around quickly. Since we're mainly concerned about the asset, that appraisal is more of a check the box because we are selling a security to our investors, so we do need an independent valuation, or we put one together. Go ahead, Ellen.
Question about the appraisal. Will the appraisal based on after repaired value you mentioned earlier, ARV, or is it the current value of the property?
So we'll get both. We'll get as is and ARV combined in one appraisal. One, we don't want, let's say you're paying $1 million for the property. We don't want that property to be worth 800 grand. I think that was a little bit more common a little over a year ago during the buying craze that you were alluding to versus now. We just want to make sure that the as-is value is relatively around purchase price. Ideally, you're getting it below market. And then we're also looking at the after repaired value. But as a lender, the way we do things, we've already kind of pre-checked value. So we're confident it's going to come in within a margin of error of what we're seeing on the front end. And again, that serves as an additional inspection for us, additional property information, walkthrough, and checks and balances on value. Another big question to ask, do you allow for junior financing? A lot of lenders out there are institutional backed and some others don't allow for junior financing. The line that they would say is, we allow for it, but just you can't be on the closing statement. What that tells me is their loan docs are probably very clear saying we don't allow for junior financing.
Can you clarify what's junior financing in case like some people don't understand what that means?
All right, so say you're going to pay $1 million for a property, and my company is going to write a loan for $600,000. We will allow you to have another loan behind us in junior position to bridge the gap to your purchase price. So say we're at 600, you have someone bring in an additional 300 as a junior loan. Now you as the buyer only need to come in with that difference of $100,000. So it's a first position loan, second position loan. In the conventional side, you'll see HELOCs at times that are in junior position and a few other loan products out there. Prepayment penalties. Do I have to pay a minimum amount of interest on your loan? That's a very important question because if you're doing a value add or a fix and flip and you're going to sell it in 3 months, you don't want to be on the hook for 6 months. Or if you're buying a multifamily property and you think your perm financing is going to be in place within 6 months, you don't want to be on the hook for 9 months of guaranteed interest. So that's an important question to have. Minimum credit score. And me, I like to ask, who's making the final credit decision? Am I talking to a loan originator to then get passed to an account manager, then to have the deal go to underwriting, then to have it go to loan committee to 14 days later, I find out I don't have a deal. I think it's very important to know that either that person you're talking to is going to be making that credit decision or they're sitting right next to them or very close because you just want to be able to get those questions answered quickly. Where can I go to verify my...
Alicia's actually want to ask if you do second lien.
We do not. We don't market it. At times we have done them for repeat clients, so there's plenty of room, but we're strictly in that first position lien holder, but we have great relationships with other lenders that we could facilitate a second position loan if it is for an investment purpose. I actually played golf with a lender in Southern California last week, similar structure company to mine, but he likes to do seconds. So we're working on one right now. I'm just trying to keep costs down, but close more deals.
So when you guys play golf, do you always go first, he goes second, just because of the fact that you do first loan, he does the second loan?
It depends on who's buying the beers. It depends on who's buying the beers.
Good.
But
and Dennis wanted to ask if there's a minimum FICO score.
It depends on the company. So you want to ask them, do you have a minimum FICO score? And actually, I challenge anyone that's on this call or listening at a later point in time, go to any Facebook real estate group and ask, does anyone have any recommendations for a hard money lender? Don't share any deals or details on the deal. You will be flooded with recommendations. They'll be throwing out high leverage, cheap pricing, things across the board, but they don't have any information on the deal itself. credit score for a lot of these lenders is very important. Track record, overall scope of work. These will dictate the pricing and leverage that you're actually able to get. Some lenders out there only want to work with borrowers that have done at least 3 flips or have 3 deals under their belt. Others are okay working with new investors, but these are important questions to ask. Us personally, no minimum credit score requirement. We just don't want to make sure that you're, wanted by half of the United States, going through a BK, and have some issues that could supersede our loan. We've seen low credit scores mainly due to there being a lot of credit under that guarantor or borrower's name. All the loans could be in good standing, but they could just have 4 different conventional loans, so their debt to income ratios look a little bit skewed on what's showing, and that could lead to a lower credit score. But I don't think it's a poor credit borrower. So I think credit scores can be misleading.
I mean, I worked with you before many years ago, and I remember looking at some deals that you sent me, and I was like, well, their FICO score is pretty low, but you had worked with that investors or the borrower over and over again, and that's why me as an investor, I was like, okay, I think we can work with this borrower and lend him money because he already has an established relationship with you guys and also established experience that they had bought and sold properties before.
Yeah, and it's also, as an investor looking to go into deals, I'm more concerned about skin in the game. When I say skin in the game, how much of their own money is in the deal? I would much rather do a 60% loan to purchase price or 65% loan to purchase price loan to someone with a mid credit score in the 550s versus a 90% of the purchase price, 100% of the rehab to someone with a credit score in the 800s.
True. That's true.
Anyway, so real quick, I won't go into this, where you can vet your lender. In the state of California, your asset-based lending company will either carry a CFL license or they'll do loans under a DRE broker's license. You could go straight to these links here, type in their company name, verify their license. The beauty about California, business owners in California hated all the restrictions in California, but it's to the consumer's protection, and just about everything is publicly available to you as the consumer in this state. So if you go to any one of these links, we do everything under a broker's license. So if you went there, typed in SNL Capital Group, you would see the broker associate, all the employees that are there or license holders. And then what will happen if we were ever audited or something happened where we got dinged for something, the DRE, they actually attach it to your profile. Same with the CFL. So if that lender got run through the ringer for doing some bad acts in the past and they got caught, it'll show there. And I think that's great.
That's a really good point, is that there are a lot of private money lender, on top of private meaning individual, that may not be an actual licensed lender. You just have to be really careful and vet them. References is important, and then check their license. That's absolutely important.
And I like to ask questions I already know the answers to.
Mm-hmm.
One of them is, how do you do your loans? What licenses do you do it under? If they can't answer that, or they give you one, it's like, I'm gonna go check it real quick. Mm-hmm. I think that's very important, because yeah, they may give you a loan, but how flexible are they going to be? What if something happens and legal gets involved? Let's not go down that rabbit hole, but I would much rather be going through a licensed party versus 100% private. For us, what do we need for an initial submission to get something submitted to underwriting? Again, heavily asset-based, all listed here. I won't run through it. And really with us, once you're pre-approved and set up with us on the front end, rolling that loan application with our loan origination software is very seamless on that. And we're just getting updated information at that point in time. Again, we're mainly concerned about the asset. What is your strategy? And what's our exit? Do you plan to sell it? Do you plan to hold it as an investment property? So are you going to need to get a refinance to take us out? Those are all questions we have on the front end. But again, we just want the strategy to make sense. Loan structure tips, kind of alluded to this on some questions to ask your lender. These are some additional questions you could ask. Again, clarifying. Ask them to explain their process. How do I get from initial like pre-qual to submission to underwriting approval to docs? Once docs are out, how does that look? And then who's servicing my loan after the fact? These are all questions that you could ask them to help explain the process throughout. But this goes back into kind of loan structures, purchase price, and rehab loan. So a new thing out that popped up over the past few years, well, they'll finance a portion of the purchase and a portion of the renovation. With that renovation fund, a lot of times there's a fund control set up for that, and it's released based on a percentage of completion. So Helen, if you're getting a rehab loan from us and we finance at 80% of the purchase price and 100% of the rehab, you would give us a call or shoot us a message, 30 days in. Hey, Brad, I'm about 40% complete from the rehab. I am flying. Things are going great. Can you release 40%? Helen, that is great news. It's moving. We're going to need to send an inspector out there real quick. They're going to go out there with the rehab bid, take pictures, and verify that all the work has been completed. And then once the report's back and verified, then we will release that 40% on that. What is an ARV? After repaired value. So you buy your property today, it's worth what it is today, as is value. You're going to put $200,000 into the property to get some future value. That future value is that after repaired value. Loan to cost. If you ask me, it's just a marketing thing. Some guys say we'll do 85% loan to cost. What that means is we're going to do 85% of that total cost. So purchase price plus rehab. Or they'll say I'm going to do 80% of the rehab, 100% of the renovation, not to exceed 85% loan to cost. Me as an asset-based lender, I think less is more. If you need an if-then statement or a spreadsheet to calculate your cash to close, chances are your loan program may not be around for very long. And we have seen some of these creative structures kind of go away over the last 6 months. And here are just a few other questions that you could ask as well. An important one. Are you talking to the actual lender? It's great to work with brokers. It's important, but you also want to know that you are direct to the actual lender. And again, we touched on these highest leverage, experience, extension, all these kind of go into play that you could ask. Pricing, can you expect? Call around. Pricing has gone up. I mean, deals that we were doing at 7.99, 8.49, a little over 12 months ago are now closer to 9.49, 10.5%. So they have gone up. Your traditional asset-based lender company, similar to structured like my firm, we're typically the last ones to lower rates, and then we're also the last ones to raise them on that side of things. Origination, I don't think you should pay over 2 points origination on any first position deal in California. If you're paying over 2 points, there's a broker involved, and that's okay. But that goes back to asking whoever's doing the loan for you, are you a broker, and how much am I paying you to get me the best deal? It's brokers bust their tails to get you the best pricing, and I think what they charge, worth their weight in gold if the loan structure and closing timeline is what you want. So we've seen deals total pricing be over 2 points if there's a broker involved, but if you're a direct lender, you're direct to a lender, you'll probably be below 2 points on origination. Pay less by knowing more. Not my line, my business partners. The more questions you could ask to vet them and understand their processes, but also what is out in the marketplace, will help you get better pricing. We firmly believe highest leverage is not always the best leverage. And I think we're seeing that now, especially in commercial that you're alluding to. We're going to probably see more commercial defaults than SFR residential going forward, because that value aspect of financing that was provided to these investors or sponsors that were probably syndicating the deal anyways and have very little skin in the game, they don't have a refinance option. So it's going to be interesting to see, and they had really high leverage. A couple quick case studies we'll fly through, open it up to questions on how you could use hard money, asset-based lending, bridge lenders, alternative lenders, depending on whatever you want to call it on a Tuesday. This is a 8-unit that we looked at in Oxnard last year. Very sophisticated investor. He's been buying properties in the Oxnard area since like the early 90s. His preferred lender, he works with Chase. Very sophisticated borrower, but he was under contract to close 12 units in Ojai. little too rural for us, and it was going to be too tight to meet that closing window to put it together. So what we did is we did a cash out refinance on an 8-unit he owned free and clear, and allowed him to put and went escrow to escrow for him to close the purchase of 12 units. From submission to underwriting and funding, it was 14 calendar days. So a lot less business days on that.
That's including his refinancing and then fund this purchase.
We didn't fund the purchase. He had cash for the purchase. He needed, what did he need? About 1.3, a little less than that net for his closing funds on the purchase. He wanted to keep leverage low to where his perm lender would have flexibility with that refinance on the takeout. So we did a $1.32 million cash out loan for him. I think our interest rate was at 8.5% or so, interest only. I think we only charged a point, but what was important to him was no prepayment penalty. He had his lender in line, and he said, "I'm going to pay you off in 3 months." Me personally, I've been told, I'm just damn near every deal, they say, "I'm going to pay you off in 3 months." I say, great. A lot of times it takes 6, 9, 10 months. So that's why we're not too concerned with the prepayment penalty, but he stuck to his word, and I think he paid us off in less than 3 months.
I think that's a very good point to make for everybody to understand that this hard money lending or private lending is not meant to be permanent loan. It's a kind of what we called a bridge also. A bridge could be a very short period of a few months where until you stabilize or until you can get a permanent financing. The idea of this hard money lending or private lending is for you to get the deal first, because that's the hardest part, is the competitiveness and the very high demand market.
Yeah, and surety of closing. If you're more confident in your lender being behind you with X amount of funds, that confidence is going to come through to your agent or realtor you're working with, to where they're going to go and write a very strong offer and say, "Hey, we're ready to go. Here's the team we have in place." And that's where we've worked with quite a few agents and brokers over the years, and we've actually seen them start taking down more deals themselves as they've kind of transitioned into investors themselves. But in this instance, his important thing that he wanted was no prepay. He's going to pay us off. Every other quote he had, and again, this one came through a broker, so that was representing him on the buy. So this is referred over through a broker. And everyone else was quoting them anywhere from 6 to 9 months of an interest guarantee, or a prepayment penalty, or a yield maintenance, all kind of one and the same. The no prepay won us the deal, and it was a great transaction for us. Next case study, I am trying to keep it to commercial ones. This is a cash out refinance we did last year. This was secured against a trucking facility / office. I know I told you we only do multifamily and industrial. That's what we market for, but we're mainly concerned about the asset. Our borrower had acquired this property in Chino, sitting on 5 acres as raw land, I think back in 2015 or 16. They self-financed the development of this office space as well as this trucking facility. So their basis in the property was over $7.5 million. They were looking to acquire a 3-unit investment property in North Tustin, and they wanted proceeds for that acquisition. So we actually paired this cash out refinance with an acquisition bridge loan on the new investment property to get them 100% of the purchase price. That combined LTV of 100%, we were sub 50% loan to value on this one and sub 65% loan to value on the other property, which allowed us as an asset-based lender, like, we're comfortable from an equity exposure while getting our client the target cash to close and loan amount. So when you want to get creative with structures as an investor or an agent, there's more than one way to use private money if you're using it correctly. And again, this is one, they said they're not going to pay us off for about 9 months. So they were okay with a 6-month interest guarantee. We knew they would be okay with that. So it was like a little win for our investors as well. So you're not going to be paid for a loan amount this size. You're not going to be paid off in 3 months. It's going to take them at least 7 months to get their perm loan in place. So it's kind of a win-win on both sides of the spectrum there. Here's case study 2.5.
Oh, sorry.
And it's 2.5. So here's the acquisition bridge loan. We put 3.41, and this is the property that they did in North Tustin.
Oh, this is a single family house?
There's actually 3 units on here, so
Wow.
they're acquiring it as an investment property. Their schedule of real estate, I think, stretch across 12, 13 SFRs, trucking facility from Huntington Beach all the way to Orange County. So they've been acquiring real estate pretty heavily over the past 4 years.
Got it. Got it. And Alicia, I want to ask, like, what about people who have mortgage late due to misunderstanding the loan forbearance? Of course, who have mortgage late due to the misunderstanding the loan forbearance.
So if I understand the question, if we're looking at a credit report and they thought they were getting a forbearance and they're not, and they got hit with late, is that
I,
the question?
I believe that's the question. Alicia, feel free to clarify.
So I'll bring this back to a misunderstanding that we were seeing during COVID, where it was on the news. Everyone was saying you talk to your bank, you automatically get a forbearance. It's not going to affect your credit score. Um, that's correct, but it can affect your lender's decision making on a future loan that you may get, because even though it's not dinging your credit, if they were in forbearance and requesting a private money loan, even for an investment property, and then we saw that they were in forbearance, the question we asked, why are you in forbearance? I'm looking at your bank statements. You got like 1.5 million cash sitting in the bank. Like, they're like, oh, our lender said it was okay. Like, we could do it. So we did. And I was like, I think there was a miscommunication there. We saw others that got thrown into forbearance and they did not request it. That was another thing that had popped up during COVID. And then we saw some where you get to the end of that period and what does that look like? And some got hit with late, so we didn't see any, but that's always the risk. And it was there for a reason. It's peak panic and big unknowns during that time frame. But the conversations we were having with our borrowers at that point in time was, do you really need the forbearance, or are you just doing this because your friend said you could get it? And I think there was needed to be a better understanding there. We're very fortunate on our portfolio. We didn't have any forbearance requests. Our investors actually wanted to buy more properties, and based on our performance, our investors that are providing us the capital wanted to get more money out. So we were positioned uniquely in the marketplace at that point in time.
So basically, for you guys, will actually look at the loan, and if there's a forbearance on their credit, you actually want to know why first to understand
Yeah.
what is the background of that before you make a decision. So it's not a hard yes and it's not a hard no either.
No, we had one borrower, we had 6 performing loans on the books, and their primaries in forbearance. We're like, why are you guys in forbearance?
So yeah,
um,
so this is very much a relationship based as well. We call it asset based. Of course, you do need to know about the property, but it's also relationship based. It's not just looking at the credit score, the credit report. Like the more you do business with the Hartman lender, the more they trust that, okay, this is just your it's sometimes just a business decision. I have done my own deals before with Hartman lending because you know what, I just need to get in first and then I'll refinance and then I'll do it again and again. So everyone has different scenario why they need to do it. We have clients also need to do 1031 exchange, and they are meeting the deadline and their lender could not finance it. So within, oh my gosh, it was like within 5 days or less than a week, we had to find a Hartman lender and close it just on the deadline, the last day, 45th day of the day. I'm sorry, the 60th day. 6 months deadline, sorry, 6 months deadline, and then finally close it so that our client could do a tender exchange without paying for that capital gain tax.
that's a very serious situation that comes up, and we love those situations as an asset-based lender, because on our multifamily or commercial properties, we could close with no appraisal. A lot of times with a 1031 exchange, they're coming in anywhere from 40 to 50% down, rolling that equity or those proceeds in
Mm.
to where, hey, let's go. Let's go as quickly as we can on this, and being able to close with that no prepay. And now your perm lender that needs more time to close that acquisition, they could breathe a little bit and start working a refinance. One thing I did wanted to bring up, Helen, that you had asked are consumer bridge loans that are available to home buyers out there. I'm not going to price those out. I could share with you guys a company based up in Northern California that specializes in this, but they have a very creative product where they will effectively cross your current home that you have with the new home that you're going to buy to give you that cash to close, allow you to close. And then once you sell the house you're currently living in, then you could pay off the loan in whole. That takes the whole contingent offer not being accepted off the table. So they have some creative structures there. There are also other just straight consumer acquisition bridge loans are typically less than 12 months. But there are options out there. If you guys want any introductions, I could connect you with anyone in my network that does it. We don't charge for it. We can't charge for it. We don't carry an NMLS, but we could connect you with some vetted lenders in our network.
Yeah, and I hope we did, kind of give you guys options here. One other thing I wanted to mention, which you kind of mentioned already, is that a lot of times these Heartland loan, like we said, is a temporary financing option. It is expensive, but it's also interest-only payments. So it's not a fully amortized payments. It's interest only, so make it a little bit more affordable in terms of the monthly payments until you figure out the permanent financing, and that's when you do a fully amortized payments with your permanent lender. I absolutely love this. I loved it so much because I do believe that Heartland Lending was my way of getting into real estate investments more than how many years ago now? 16 years ago. And that was my first deal. I used Heartland Lending, and that's how I started real estate investments. And I've seen how it worked for my clients as well, and help them get into properties that they want until they stabilize the property. They can do a permanent financing, and then they basically gain equity by able to get the deal first. I close escrow really quickly. And I loved it so much that I actually went to the other side to be the investor. That's another way of, if you have some money that you don't want to buy a property, but you want to earn some high interest, you can become the investors for a Heartland lender like Brad, which was what I did back then. And loved it, absolutely loved it. You get the high interest payment every month, and they mail you the check. Well, maybe nowadays you deposit it, but it's a really great way to invest your money as well.
Yeah. Well, Helen, thank you for, if there's any other questions, I could jump into them, but you have anything else for me?
No, I think I thought this was very interesting. I hope that this helped everyone. If you feel like you're struggling to make offers and you want to have a stronger offer, this is the way you can try to explore, as long as the number makes sense. Work with your realtor to run the numbers, and then talk to a Heartland lender. And I hope that everyone will have a happy house hunting. And also thank you so much, Brad, for joining us. And then next month, we're going to be talking about insurance for commercial real estate. So please do come back and visit, and hopefully this rainy season is done by next month, so we have no more power outages.
I'm ready for summer. I don't know about everyone. This is a good summer here.
Thank you so much. Thank you so much. I cannot wait to see some sun. All right. Everybody have a good rest of the day.